All eyes were looking at the Federal Reserve for this week as they made their announcement and their decision on interest rates. So thanks for tuning in. What I wanted to discuss with you today are some of the investment trends that we are seeing for the week of September 18th. So this past Wednesday, a lot of focus was on the statements and the comments from Fed Chair Jerome Powell as he decided to keep interest rates where they're at for the time being. However, he did indicate that interest rates could remain higher for longer, and he did not rule out that they may raise interest rates by 25 basis points at some point between now and the end of the year. He is remaining very cautious, and he did say that they've made great progress in the fight against inflation. One of the things that he indicated is that he anticipates by the end of 2024, the unemployment rate could get to about 4.1%. And he also thinks that they could get to their 2% target rate for inflation at that same time. So right around the end of 2024. That would be almost a dream case scenario if he can keep unemployment rates that low and keep inflation down to around 2%. The market did not react positively to this news as they're anticipating interest rates staying higher, meaning around that 5% range for even longer and might become the new normal. So what that did, there was 3 pretty significant days of losses with the tech sector. So the NASDAQ being hit the hardest, that was down almost 3.5%. The S&P was down about 2.5%. Saw a slight uptick in the morning of the market on Friday. However, we still are anticipating pretty significant losses for the week. So one of the things that drives tech stocks down and tech companies is that on their balance sheet, they tend to have a little bit more debt. So if interest rates remain higher, these companies, in essence, become a little bit less profitable. So that's why we saw the dip or the crash in some of the tech names that have been the high flyers so far for this year. On the other hand, Treasury yields and bonds have remained around a 15-year high on the 2-year, 5-year, and the 10-year notes. In other news, there's continuing strikes amongst the United Auto Workers. So the UAW is striking against 3 large automakers, and some of the things that they are demanding are around a 40% increase in pay, 32-hour work weeks, and the return of the pension and medical insurance for retirees. So there's no clear path yet on when these strikes may come to an end or a decision to be reached. One of the things that is likely to happen is that they will see these pay increases. However, the likelihood of coming back in the return of a pension or medical insurance for retirees would cost a lot of these automakers billions of dollars and could cause them to become less competitive against companies like Toyota and Tesla. So where should you put your money now? So a couple of things to consider and a couple places to look on where you can start to allocate some of your investments. We've seen large fund flows into private credit funds. So these are funds that lend to companies that banks typically might not lend to. And one of the reasons for more and more money being poured into these funds, we are seeing rates and yields in private credit funds as high as 10 and 11%. So if you have any interest in getting into any sort of private credit funds, reach out to me, let me know. Happy to help you. This can be a great allocation for your fixed income portfolio, and we're seeing pretty significant yields. So that's it for this week. If you liked the video, go ahead and like it, leave a comment, let me know some of your thoughts, and have a great weekend.